Right now, thousands of Australian pensioners are about to receive less money from Centrelink, and most of them have no idea it's coming. Starting September 20th, 2026, deeming rates are rising again. If you have savings, a term deposit, or a joint account with your partner, this change could quietly reduce your age pension payment. Let's talk about exactly what's happening and what it means for you. Welcome to Centrelink Pension Bulletin, the channel that keeps you informed, prepared, and ahead of the changes that matter most in your retirement. Today we are covering one of the most important topics for pensioners in 2026. How does Centrelink assess your savings and term deposits? How does it work for singles versus couples? And what on earth happens with joint accounts? By the end of this video, you will understand the whole picture, simply, clearly, and with the very latest numbers. Let's start with a word that confuses a lot of people: deeming. Deeming is the method Centrelink uses to estimate how much income your savings are producing. Here is the key thing. They do not look at your actual interest rate. They do not check what your term deposit is really earning. Instead, they apply a fixed percentage to the total value of your financial assets, and that becomes your assumed income for the pension income test. That assumed figure is called deemed income. Under the deeming rules, you are deemed to earn a certain annual rate of return on your financial assets, regardless of the rate of return you actually earn. This affects savings accounts, term deposits, shares, managed funds, and your superannuation once you have reached age pension age. Now here is what is changing, and this is brand new information as of this week. Alongside pension indexation increases, the government has lifted Social Security deeming rates. From September 20th, the deeming rate will increase from 1.25% to 1.75% for financial assets up to $66,800 for singles and $110,600 for couples combined. For all financial assets exceeding the threshold, the rate has risen by 0.5% to 3.75%. This marks the third rise since a pandemic-induced freeze was lifted last year. So if you are already receiving a part pension, your deemed income is going up from September 20th, even if your savings haven't moved a single cent. Now let's talk about the good news in this same announcement, because there is some. From the 20th of September, pensioners are set to receive up to $36.80 extra to $1,237.70 a fortnight for singles, $0.70 a fortnight for singles, while pensioner couples will get an additional $55.60 to $1,866.00. So the pension rate is going up, but the deeming rate is also going up at the same time. If you hold deemable assets and receive the age pension, you might find your payments shrink come September 20th, or that some of your indexation benefits are offset by a higher rate of deeming. In plain English, the rise in your pension could be partly or fully cancelled out by the rise in deeming. That is the hard truth many pensioners will face next month. Now let's break down exactly how deeming is calculated, with real numbers. From September 20th, 2026, the rates are 1.75% on the lower portion and 3.75% on the higher portion. The thresholds stay the same: $66,800 for singles and $110,600 for couples combined. Let's say you are a single pensioner with $150,000 in a term deposit. Centrelink splits that into two portions. The first $66,800 is deemed at 1.75%. That gives $1,169 per year. The remaining $83,200 is deemed at 3.75%. That gives $3,120 per year. Your total deemed income is $4,289 per year, or about $165 per fortnight. Centrelink then counts that $165 as income under the income test. From 1st July 2026, a single pensioner can earn $226 a fortnight before the pension starts to reduce. So in this example, $165 per fortnight is still below the threshold, and the income test would not reduce your pension. Good. But what if you have $300,000? Then your deemed income jumps to roughly $327 per fortnight. That is $101 above the free area, and every dollar above the free area reduces your pension by 50 cents. So your pension would be cut by about $50 per fortnight, or around $1,300 a year, purely because of deeming. You are not earning more, your bank account has not changed, but your pension goes down. That is the deeming squeeze. Now, here is something many people do not know about term deposits specifically, and this is genuinely useful. When actual bank interest rates are high, deeming is highly beneficial for pensioners. If you have money in a term deposit earning 5%, Centrelink is still only assessing that money at the deeming rates. You get to keep the extra interest without it affecting your pension. So if your term deposit is earning more than the deeming rate, you win. Centrelink only counts the lower deemed amount as income, not your real interest. The extra money you earn sits in your pocket and does not touch your pension. But deeming is based on assumed returns, not actual earnings. If your actual investment returns are lower than the deeming rates, for example, if you keep large amounts in low-interest bank accounts, the deemed income could be higher than what you're actually earning. There is no general waiver for this. So if you have large amounts sitting in a basic savings account earning almost nothing, Centrelink still assumes you are earning 1.75% or 3.75% on it. You could be assessed on income you are not actually receiving. This is why many retirees benefit from moving low-interest savings into better-performing term deposits, so your real returns at least match what Centrelink is assuming. Now let's move on to something very important, how all of this works differently for singles versus couples. For singles, only your own financial assets are assessed. Centrelink looks at what you own, applies the deeming rates, and calculates your deemed income. Simple. For couples, the rules are quite different. If you have a partner, the combined value of your super and other financial assets is used to calculate your deemed income. It does not matter whose name the money is in. If one of you has a term deposit worth $200,000 and the other has savings of $100,000, Centrelink sees $300,000 combined. The 1.75% rate applies to the first $110,600 and the 3.75% rate applies to the remaining $189,400. That is the couple's combined deemed income, shared between both income tests. This is a fairer outcome in many ways because the couple threshold of $110,600 at the lower rate is much more generous than the single threshold of $66,800. Couples get a bigger protected zone before the higher rate kicks in. But the key point is this. Combining assets means you cannot hide money on one side of the couple to get a better result. Centrelink sees through that immediately. Now let's talk about joint accounts, because this is where many people get confused. A joint bank account is one that belongs to two people. Both names are on it, both people can access it. This is very common for married and de facto couples. So what does Centrelink do with joint accounts? The entire balance of a joint account is counted as part of the couple's combined financial assets. Centrelink does not split it 50-50 and give each person their own separate portion. The whole amount goes into the combined pool. Then the deeming rates are applied to that total as a couple. So if you and your spouse have a joint term deposit worth $150,000, that full $150,000 goes into your combined financial assets, along with your superannuation balances, your separate savings accounts, and any other investments you both hold. It all gets added together, and the deeming rates are applied to the total. There is no benefit to putting money in a joint account versus individual accounts from a Centrelink assessment perspective. What matters is the total combined value. There is one situation that catches many couples off guard. What if only one of you has reached age pension age? Almost everything counts. Bank accounts, shares, managed funds, ETFs, investment properties, vehicles, and superannuation once both partners have reached age pension age. A younger partner's super isn't assessed until they qualify. So if your partner is younger than 67 and still has money locked inside their superannuation, that super balance does not count in the assessment just yet. But the moment your partner turns 67, their super comes into the picture. This is something important to be aware of and plan for in advance. Now let's talk about the assets test, because it works alongside deeming and both tests affect your pension. Centrelink runs two tests on you, an income test and an assets test. They pay you based on whichever test produces the lower pension payment. You can't choose which test applies, both are run, and the lower result determines your payment. A single person can have assets up to $745,750 before the age pension cuts out completely, or $1,012,750 if they don't own a home. For a couple living together, the combined limits are $1,121,000 and $1,388,000. For a full pension, the full pension is available under the assets test for homeowner singles whose assessable assets are under $333,000. For homeowner couples, the number is $499,000. If your assets sit between those two numbers, you are in what's called the taper zone. The pension reduces by $3 per fortnight for every $1,000 of assets above the full pension threshold. That might sound small, but if you have $200,000 above the threshold, that's $600 less per fortnight, more than $15,000 less per year. And importantly, your family home is not counted. The family home, your primary residence, is excluded from the assets test regardless of its value. A $2 million home does not affect your age pension eligibility. Only financial assets, investment properties, vehicles, and other assets count. This is one of the most important facts in the entire system. No matter how expensive your home is, it does not count against you. One more thing worth knowing. You might be tempted to gift money to your children to reduce your assessable assets, but be very careful with this. Gifting above $10,000 in a financial year or $30,000 over a rolling 5 years doesn't reduce assessable assets as many expect. The excess remains counted as an asset for 5 full years from the date of the gift under Centrelink's deprivation rules. So if you give $40,000 to your grandchildren this year, Centrelink will still count $30,000 of that as your asset for the next 5 years. Always speak to a financial information service officer at Centrelink, it's free, before making any large financial decisions. Let me bring it all together with a quick summary of the most important points for 2026. From September 20th, 2026, deeming rates rise to 1.75% on the lower portion and 3.75% on the higher portion. The thresholds stay at $66,800 for singles and $110,600 for couples combined. The age pension also rises. Singles to $1,230, 7.70 per fortnight, and couples to $1,866.00 combined. But the deeming rise may offset some of that increase for part pensioners. Term deposits can actually work in your favour. Centrelink only counts the deemed rate, not your real interest. If you are earning more than the deeming rate, you keep the difference without it affecting your pension. For couples, all financial assets are combined, regardless of whose name they are in or whether they are joint or individual accounts. Joint account balances count in full towards the combined pool, and both the income test and the assets test apply. Centrelink pays the lower result. Your home is excluded. Gifts above $10,000 per year stay on your assessable list for 5 years. If you are unsure how these changes affect your specific situation, the best step is to call Centrelink's Financial Information Service on 1800 007 007. It is completely free and confidential. If this video helped you understand your pension better, please give it a thumbs up right now. It costs you nothing and it helps other Australians find this information when they need it most. Subscribe to Centrelink Pension Bulletin so you never miss an update, because these rules keep changing, and staying informed is how you protect your retirement income. Drop a comment below. Are you a single pensioner or part of a couple? Did you know about the September 20th deeming rate rise? We read every comment and we love hearing from you. Coming up next on this channel, we break down exactly how much each type of pensioner will receive after the September 20th changes, with real dollar examples for singles, couples, homeowners, and renters. You will not want to miss it. Thank you for watching. Stay informed, stay prepared, and we will see you in the next one.